guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cashflow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income producing real estate investments. Now, our guest for this week's show is real estate investment expert Patrick Grimes. Now, Patrick is the founder and CEO of Passive Investing Mastery, a private equity firm specializing in non-correlated passive alternative investments in real estate, private debt, litigating finance, and energy. Now, starting with single-family rentals, Patrick has been investing in alternative investments since 2007. He founded the private equity firm Invest on Main Street and has scaled his holdings to a portfolio of over 5,000 apartment units valued at over $600 million across the southeastern United States. Now, he then created Passive Investing Mastery with the mission to educate investors in the art of alternative investing strategies and to sponsor best-in-class investments. So, guys, without further ado, I'd like to welcome Patrick Grimes to the show. My friend, how you doing today?
I'm well and excited to be here. I had you on my Mastery series about a year ago, probably, and it's great to be hanging out with you. Also, rub shoulders with your partners a lot, so you guys are good friends out there in the alternative space.
Absolutely. Well, no, I know you've done a lot of great things over the years that you guys have been out there just educating folks. You've simultaneously built a very large private equity firm as well, and you guys got your fingers in a number of different pots. So excited just to really get a better understanding, Patrick, of who you are, what it is you do, kind of where you guys are spending your time, energy, and focus today. But I guess let's back it up a little bit. For those that aren't familiar with your name. Don't know who you are and a little bit of your background. So let's start there. Again, I gave you the brief introduction, but I didn't really go deep. Maybe expand upon where you got your start and ultimately how you found your way into the world of alternative investments.
Sure. Well, like many of your listeners, I was a hardworking professional out there battling my way in corporate America. I did machine design, automation, and robotics. I was a mechanical engineer, and I had a master's in engineering and an MBA. Got some advice early on that when I asked the founder of the first machine design firm I worked for, how to invest, what should I do? I mean, I was thinking he was going to say, hey, this medical device or aerospace startup, which we were not far from Silicon Valley. So there was a lot to choose from. He said real estate. I was like, what? He goes, yeah, I make all my money in high tech and I dump it in real estate. And he said, that's what will really get these alternatives outside of the stock market and high tech. Those are really what will get you to the financial security that you want for your family in the long run. And his only regret was not buying more sooner. So that's
isn't that always it? I feel like that's always the biggest regret, right? It's like anyway. So sorry to interrupt you, but keep going, please.
Well, yeah, and it goes both ways because that happened to me in 2006, and by 8 and 9, I was knee deep, elbow deep, neck deep, and then completely underneath a pre-development project. And so I lost everything in 2009 and 10 during the subprime mortgage collapse. So I went real big, real soon. I didn't know what recession resilience was. I didn't know what buying cash flow and producing assets was. I looked at really great shiny colored returns in 2 to 3 years, double, triple my money and, get rich and retire quick. That didn't work out for me.
So very interesting. So your first experience was kind of a boom and a bust, right? Or maybe the boom necessarily never even got to a boom, right? Just more of a build up to a bust. And so interesting that you were able to, just really, you hadn't even you had a taste of success from your corporate gig, right? Like you were doing well, but doesn't sound like you ever really got the real taste of what real estate can do as far as building wealth, before 2008 crushed you. Is that an accurate statement?
Yeah, absolutely accurate. I was battered, beaten, broke, bruised, ego was hit after that. And so I hunkered back into my career and I was just like, look, I'm still a talented engineer. So I got a master's in engineering and MBA and started doing well again financially. And next thing I knew, I was back on where to invest path. And that's when I followed the breadcrumbs of the wealthy, and it led me back to alternatives outside of the stock market, but kind of different approach, wealth preservation, tortoise, not the hare, buying for cash flow, lower leverage existing assets. And I started studying a lot about allocation strategies and recession resilient markets and learning how to allocate in ways in which I won't lose my whole shirt again. Maybe I'll lose a button. but not my whole shirt again. And so that's what kind of led me down this path.
So what did that, version two, what did that look like? I mean, what were the types of real estates that, that you were looking at that point in time? Obviously existing cash flowing investments, but was that when you kind of opened your eyes up to multifamily or?
So I hadn't learned to partner yet. I was still a do it myselfer and do it with my own money, and which is a natural progression. And so I did the
Yeah.
single family approach, which if you look on Forbes, Patrick Grimes Forbes, you can read about 20 articles or at least a dozen that somehow point around how single family won't get you there. Partnering up in a larger assets, apartments and other energy, legal, medical, other investments and other markets will. Yeah, so I found Houston to actually be the most stable market that I could find that had the best opportunity for cash flow, landlord friendly, tax advantaged, and had the stability through the collapse, subprime mortgage collapse, where it just barely tapered off before it went back up again. And so I started buying from California, from high tech job in California. I started buying rental properties in Houston, and it was working. I was basically doing the Burr method,
Hmm.
but I didn't know what it was at the time. I was buying and I was renovating, and then I was refining, and then I was renting, right? And then I was repeating. So, but the problem is that like probably many of your listeners, you're really good at something. You've made money doing something that you're really good at, whether you're a doctor, an attorney, whatever it is. I was an engineer, and I started trying to get really good at something else, and I was doing all the jobs in this something else. So it was really taxing. It was really laborious because didn't want to do everything related to owning and managing properties and finding and acquiring and selling. I just needed to do it because I felt like that's what I had to do. And then it just took over. It got to the point where my night job was just, which was this real estate portfolio, which is more than I can handle, and marry my wife. And so my my wife was there for my very last single family closing, my soon to be wife, and I said, look, I'm going to take a break for 2.5 years. We're going to come back to it differently, but this is the last one I'm doing, and I stuck to it. We got married, California and Beijing. She's from China, and then that's when I came back and I learned I got to do this differently. I got a partner. I got to scale. Learned how to create a private equity firm. Learned how to use other people's money. Learned how to partner with operators in different states and different markets and different assets. And that's where I find myself today.
Yeah. I do think that there's a lot of value. I know that maybe it's not the most efficient way, doing everything yourself with all your own capital, right? Like literally, from buying it to funding it to managing it to renovation, all that. I mean, I know that that is not the most efficient way. However, I do think there's a lot of lessons there that get carried over. I do think it's important. I do think it's important for individuals to risk their own capital and put themselves into a corner that they have to fight their way out of with their own capital first before taking on investor capital. I'm not saying that's the only way. I'm not saying that it's the only right way either, right? Like it's just, but I do think that there's some lessons and values that come out of that make you just a better investor and also a better fiduciary of others' capital. Again, just my opinion, but I do feel like a lot of what again, I same thing. I did a lot of things in the early stages by myself, and to the point where I was literally at my bandwidth, right? I was like, damn, this sucks. This is not fun. I'm making money, but like this is not fun. Whole idea here is to own a business, but ultimately have it to where a business can buy you some time freedoms, right? And not necessarily be working 80, 90, 100 hours a week.
Yep.
And obviously you just you get pushed into the corner. You figure it out. You figure a better way, a better mousetrap, a better mousetrap. There's always a better way, right? So, but it forces you into critical thinking exercises, and it puts a level of stress on you, and it makes you. It's like fight or flight, mode. And I think again, I just think that's important because ultimately, even if you're taking investor capital, you get to that next stage, you're raising capital, there inevitably will be a challenge, right? Like there's going to be challenges, bumps in the road. We just went through a difficult period of time for the last couple of years with the interest rate increases and devaluing of assets and a whole bunch of other crap that's kind of culminated over the last couple of years. And you got to figure it out, right? You got to work your way through it. Like this is not ideal. There's lots of challenges out there that we got to work through now. And now, guess what? You're responsible for capital for many many other folks, and you got to be able to answer to those individuals and
Yes.
have a clear. a clear thought process and a clear path of here's what we're going to do. Here's inevitably how we're going to fight our way out of this, right? And it might not be, um, the best answer, as far as to investors, but like at least have a plan. You have a plan of attack, and again, I think that some scars that you get earlier on from battling through it yourself ultimately carry over and just make you a better fighter. When you're
Mhm.
out there raising capital from others. So anyway, just again, I don't know if that's right or wrong, but it's kind of how I feel. I do think it's important. So I always suggest folks that, even if it's a little, whatever capital you have, doesn't have to be hundreds of thousands, millions of dollars, right? But just risking something yourself before risking someone else's something, right? And putting
Right.
some of your own skin in the game on
Mhm.
the line and seeing how that feels before you go take on the heavy burden of bringing capital from outside sources. So anyway, I didn't mean to derail there, but just figured I would interject and
All
give
good
my
points.
2 cents. So let's talk about I guess where I would love to get a general understanding where you guys are at, where you're spending your time today. What Invest on Main Street is your primary private equity vehicle, correct? That's kind of what the umbrella that you guys run under. Um,
No, it's passive investing
it
mastery.
is okay. Oh, okay. I thought that was just the educational side of things. Okay, so Passive
So we have
Investing
the
Mastery
Accredited
is the
Investors,
private
which we
equity firm.
scaled in. Yeah, we scaled some apartment buildings and invest on
I
Main Street, but
understand.
we actually got some pushback. So when we started doing things like, well, I actually believe a correct portfolio allocation is not all in real estate. I think that, if you look at the pie charts of the Tiger 21, the larger wealthy, or
Hmm.
you look at Edward Wolf that plots allocations of the middle class, upper class, and ultra wealthy, you start seeing that 20, 40, 50% of their wealth are in alternatives, whereas maybe 25% might be in real estate.
Yeah.
So where's that other 25? Where does that go? And real estate, it rides waves. I lived through one. So where else can you allocate? And so we
Hmm.
started doing things like oil and gas, which helps to give tax advantages and also gives a completely different curve than stock market and real estate. The ebbs and flows are different. So it helps to balance out your portfolio. We're doing debt instruments right now, where we're seeing debt being really, really strong with high interest rates and strong demand, while real estate is down, right? And so we're seeing in our debt funds very strong returns, and then also legal. We're actually promoting things like education, healthcare, and the legal industry. Why? Because those industries, investments in those just ride a steady, tried and true needed regardless of downturns. So it can be counter-cyclical or anti-cyclical. These things just simply aren't affected. They don't care. And so that's why we have legal funding or litigation finance, because the legal industry is a steady, tried and true, doesn't look in the past. It doesn't care if COVID happened, doesn't care if the real estate crash, the stock market class. The attorneys just simply get paid. and and the judicial system, the United States government, just trudges along. And so by accessing loans into real estate and giving operators funds to buy properties, you can access the legal industry by giving attorneys funds to be able to pursue cases that they couldn't otherwise do other than through contingency fee. And so we provide it and we can participate in settlements. So it enables access to justice for those that otherwise couldn't afford it. So investments like that provide stability, more of those such than independence. Like I had financial independence in the real estate space, but then real estate can collapse. But
Hmm.
true security happens when you have foundations across multiple markets such that you're not destabilized by any single one. And that's what
Yeah.
passive investing mastery is about. So we had to create something that wasn't real estate focused
Understood.
and create a new platform that would be able to, I could be like, no, this is actually what I believe allocations are like. And it's a more general alternative investing platform.
Yeah. No, I appreciate that clarity. Thank you for that. Very curious, the litigation finance side of the business. Help me better. Give me paint the general picture as to what that looks like, and who's it for, who's utilizing it, and just general terms. I'm curious. I'm not don't know too much about the legal industry. Definitely don't know anything about the finance side of the legal industry, but very curious.
Well, so if you think about industries that you want to invest in, ones that are both recession resilient, right?
Hmm.
That tend to be pretty steady. Got to figure out how to access those industries. And so with litigation with the legal industry, it's pretty simple industry. It's about, I mean, it's pretty big industry, right? It's billions of dollars, but it's pretty simple. There's hourly rates, court fees, filing fees, expert witness fees. It's not that complex. Like the bill of material of a case it's not unfathomably complex like the bill of material or cost of goods for a plane, right? It's pretty simple. So you got to figure out how to access it. And then you go to the industry and say, hey, look, what do these attorneys need? There is an entire industry of attorneys out there that are providing access to justice, representing those who can't afford it. They call that engaging either in pro bono or contingency fee. Pro bono means it's free. Contingency fee means, hey, look, the attorney's going to go ahead. They're going to put up the cost. They're going to eat the hourly rate. They're going to pay the court fees, filing fees, whatever, all the fees required to provide the representation. But they'll sign an agreement saying, hey, look, I will participate with you in the settlement proceeds. So in our case, the attorneys that we're lending to, and it's very similar in our case to lending in our debt fund, where we have a diversified portfolio of loans to real estate operators that are buying or improving properties to house tenants. We're providing loans to attorneys that have a track record and skin in the game that need the operating expenses to get their current cases, their current clients across the finish line, or they want to acquire more clients called claimants, and they want to increase their book of business or their docket. And so it's very similar. And then we'll participate in the proceeds on exit. So we are working primarily with big like Goliath evil, what we call them defendants or corporations or organizations out there that it takes an attorney hundreds or thousands of people. And we don't do what's called class action. It's a little different than what we do. We're doing something called mass tort, which just literally means mass wrong or injustice. And those are thousands of individual lawsuits, such as like Camp Lejeune. One of the cornerstones of our diversified litigation portfolio is that military base where our civilians and military and their families, as well as vendors, all were exposed to contaminated water for like a 17-year period. And now they're like dying of horrific diseases. The DOJ's taken responsibility for that. They published a grid saying based on how long you were there in the disease you have, how much you're entitled to. And so we have thousands right now of military, civilians, and others that were exposed to contaminated water at Camp Lejeune that we're assisting in representation so they can get meaningful settlements, not like a class action like $50, $75, $80. Yeah. But we're talking $100,000, $300,000, $400,000 that make a meaningful difference for these claimants.
Got it. No, I appreciate that. And just typically, how are these loans secured? I mean, with these various law firms, what do you guys look for as far as security?
So similar to a real estate deal where you have somebody might come and say, look, I've got a property. And I've got an appraiser that appraised it. It's got this certain value, right? And can you lend on a certain percentage of that value? And then you'll put like a UCC1 filing, or you put a lien on that property, right? As a lender, just like we do in our debt fund. Similar to any asset-backed lending, this is a billion. This is like the mass tort industry is literally the size of the airline industry. It's in the hundreds of billions of dollars. So we have law firm valuation specialists that go in there and they'll review essentially the assets of a law firm. They'll go through and say, oh, these are all the cases. These are all the claimants. These are all the harmed individuals. They'll go through and they'll look at the exposure, proof of exposure. They'll look at their medical records and they'll indicate, okay, yeah, these guys actually have a claim. And based on what, in the case of Camp Lejeune, this early settlement grid, or in other ones like we're going after Monsanto and Roundup, or these other ones like firefighter, PFAS, the forever chemicals, or we're doing a bunch of human trafficking and sexual assault stuff, you can see where they've settled or they're already settling in cases. So you can say, okay, this is what the settlement value is. Here's what the cases you have. So here's the value of your current book of business in terms of the settlement amount. And then instead of in real estate where people will lend like 60, 70, 80 cents on the dollar, we'll lend 10, 20, 30 cents on the dollar. And then we'll
Hmm.
get preferred payback terms before the attorney gets anything. The claimant gets theirs, and before the attorney borrower gets anything, we'll get preferred payback terms. And then we'll do a UCC1 security against the attorney and their assets. UCC1 filing a lien. It works fundamentally the same as any kind of asset-backed lending type of environment with all the same kind of mechanisms that provide you the security.
Very interesting. And then what does that look like on the, the investment opportunity, for folks that might be tuning in, wanting to get involved? What do those terms typically look like?
Well, there's lots of different, just like in real estate or oil and gas or
Sure.
angel investing, you can get involved in really early on speculative risky stuff. Like you can make it rich striking oil in a in a gold mine or oil
Hmm.
and gas well wildcatting, or invest in 100 angel investments and lose 99 and make one, or whatever it is. There's those, and there's the same thing in legal. You can get into very speculative cases that are kind of on the verge of like barely, there's no case law, they haven't. So we're in this other side where these cases have been around a long time. They've already been aggregated together by attorneys. They've already been filed, these mass tort, or they're in the later stages of settling. And it's the case that 90% of civil lawsuits settle. It's really a game of settling at that point, anyways. And so the question really is, how much are the settlements going to be and when? And that's really when we target sort of that really late staged, close to the end, where the attorney is either like, hey, look, I need some help getting these current guys over the finish line, or I'm so close to the end, I can only add people for a short period more.
Hmm.
Can you give me $500 million to help me market and add a bunch more people to make me scarier so that the defendant will settle sooner, right? So we'll help them in both of those ways. So that late staged isn't like 20, 30x, it's more like 20, 30 IRR. And that's what we're projecting in our diversified litigation portfolio. And the win loss, like I said, most of them settle, but with thousands of individual lawsuits across many, we have like a dozen different types of cases in there now. We get a really interesting portfolio of cases that will settle throughout a 2, 3, 4 year period. And so it's kind of a very interesting return profile where you expect most of the return to be middle loaded and then some of the, trickled out at the end. It's kind of like saying you're going to build a housing development, and then as you finish the units, you're going to sell them off. Some of them might take, there's some of the later ones might trickle towards the end, but most of them should be finished in the middle, right? So it's a very strange kind of bell curve of return
Hmm.
profile.
Is this a fund structure, or is it one-off
Mm-hmm.
individual deals that you guys are allocating capital for
So part of our strategy is
in
put
the
together.
litigation finance side?
Yeah. So our strategy is it's a diversified litigation portfolio. It's not
Hmm.
a open fund where you stays open forever. Uh, we raise for a while. We originate assets, and then once we get to a critical amount of diversification, which we're getting close to in the fund we're in now, we're going to stop raising. We'll open up another one, right? And that way we allow our ability to sign up a bunch of cases, and then see those through, and then open up another one, sign up a bunch more cases, right?
Does it, once someone, your current fund, you said as an example, is it actively paying distributions, or how does that work?
So unlike in real estate, where the underlying asset is a rental property where there's steady eddy
Yeah.
cash flow coming out, right? Litigation funding in our methodology is funding attorneys so we can pay their hourly rates and court fees to get it across the finish line. So there is no inherent cash flow.
Hmm.
So this isn't inherently a cash flowing asset. Now, because we have thousands of different individual
Yeah.
lawsuits across lots of
They settle
cases,
at they settle at different times, I'm assuming, correct? And
yeah,
that's
we
where
have
it
like
comes from.
so we actually showed kind of a distribution profile, kind of what we're anticipating the settlements would come in at, but we took it off because people are like, oh, so it cash flows on this, and I'm like, no, it's not a cash flow; those are distributions,
It's just
right?
lumpy. It could be a little lumpy.
It's beneficial because you're not waiting for one refi or one sale
Yeah.
event, right? You've got essentially thousands of lawsuits, but it's hard for investors to kind of grapple with that concept.
Yeah. Very interesting. No, it's the first I've ever heard of it. Just I'm sure there's probably even more questions. There's probably questions that I have that I don't know I have, and I'm sure folks that are tuning in, this is the first time we've ever talked about this in the show. So just what else? I guess I'll throw it back to you, Patrick. What additional question should we be asking about this, investment strategy? Again, as it relates to litigation finance. I mean, what are some of the other, you know, important items that folks should understand as it relates to this investment vehicle?
In the real estate space, people tend to live in a little bit of a bubble, like this is all we got in real estate. But actually,
Mm.
these other alternative investing strategies, whether it be medical device receivables or litigation finance or crypto or like gold mining or technology, those are actually fairly well known by those who study alternatives because they're coveted essentially in that they don't rise and fall together, right, with a greater portfolio. So it de-risks the aggregate portfolio and provides much more stability into.
Mhm.
So that's why my partner, who's been doing litigation funding for decades, he did it for large institutions and hedge funds. And I started trying to do business with him, 3-5 years ago, but he was like 20 million, 50 million buy-ins. I wasn't quite there yet, Kevin. So I couldn't, but it took a number of years for us to set one up and give access to accredited investors. But it has been around for a very long time. The first litigation funding that was in America was actually against American tobacco. And it was
Hmm.
when a bunch of people got together and said, hey, look, these cigarettes, which they keep saying are healthy, I don't think they are because we're just dying horrific diseases. But these were the disadvantaged people. And so there was the first instance of a third party coming in America and funding a large aggregated cases together was that American tobacco. And they won. And that company is one of the ones that, of course, the actual attorneys are dead, but that same company is one of the ones that is some of the leadership in some of these mass torts that we're allocating in today.
Hmm.
But there's lots of these cases out there. And the ones that are really interesting is right now we've got allocations into sexual survivor, sexual assault. And you can look it up online. The LA Juvenile Detention Center is almost facing a shutdown because there's been so many cases within the system, and they failed to correct it ongoingly for years. That they're just threatening to completely shut down the LA Juvenile Detention Center. So we have allocated and are representing individuals who have been harmed, assaulted through the LA Juvenile Detention Center. We're seeking meaningful settlements, and they've actually just indicated a desire to settle. So there's,
Hmm.
for example, there's human trafficking. There's cases like some of the ones that are kind of heartbreaking, or like the NEC infant baby formula one, where it's just, there's baby formula with heavy metals and these things that are harmful. So we've got some cases wrapped in there. There's ride sharing claims where, these people, sometimes they knew this was going on, but instead of alerting authorities, they made an intent to cover it up. And they didn't correct the business practices to create a safe environment for their employees or whomever they're looking after. So there's a lot of cases like that, which it's really
Hmm.
cool. It's really cool what we're doing, right?
Yeah.
I think it's really neat. In general, I just ask people to kind of look back and take a stab at, hey, here's a pie chart. Where are my investments? How much do I have in the stock market, bonds? How much other real estate? And try to say, like, well, how confident do I feel about each of these pieces right now? And what if there was a time where real estate crashed, or a time where real estate and the stock market crashed? How do I feel?
Hmm.
Do I have oil and gas? Am I okay with? Can I stomach what oil and gas prices sometimes do? Right? And am I comfortable with that? Do I feel like I should maybe seek an allocation that is a completely different fundamental curve that doesn't ride the same, so that I can put some money away and know that, and if all the worst happens, I still got something else somewhere
Yeah.
that's going to chug along and come back to me as a judicial system here in America, which we're famous for globally, as that plays out. The rule of law plays out. And so
Yeah.
that's usually what I tell people, to just take a minute,
I
step
know.
back.
Yeah, and I know, Patrick, I mean, you speak to this quite often. You've got a lot of different free resources on your website. I know you've got numerous videos out there floating around, different classes, things of that nature. So I guess for those that want to dive a little deeper into alternative investments, get a better understanding of this diversity of allocation and just the things that we're talking about here today, just maybe go into a little bit of some of the different resources that you have available, where they can find them. I believe your website's chock full of it, but just if you could share a little bit more of what folks could find when they go there.
I'm proud to say you're one of them on there, Kevin, because
Whew.
you're one of the alternatives out there that are very notable and strong, and that I'd like to expose investors to. And if they want to meet more Kevins out there in the world, more Sunrise Capitals that are
Yeah.
in completely different alternative investments, passiveinvestingmastery.com, passiveinvestingmastery.com. We have a bi-weekly webinar that's turning almost into one every 2 weeks, every week almost, where we bring in completely different alts. We have one on today, actually later, we have one on airline investing where you can buy a plane for cash flow, or you can invest in educating pilots. It's 65,000 pilot shortage right now, and be part of that. And it's really interesting. We've had bourbon barrel cask. We've had crypto, technology metals, how to balance precious metals in your portfolio. We've had parking lots, ATM machines, just everything you can think of, laundromats, all these different alternatives, legal funding, medical receivables, all these different alternatives that I used to, just like Kevin and I, and probably maybe a handful of others, I'd just trade the baseball cards of these alternative investments into this like little micro huddle group. And I've just decided that, man, when I was an engineer, I wish I knew more than just real estate. I wish I knew more than just oil and gas. I wish I knew more of these typical, sort of novel, non-traditional, lesser known alts that can provide, I think, true sustainable wealth growing. And this is that platform I wish I had, where you can join and constantly get exposed to these new alternatives and get more comfortable and start building an allocation strategy. So passiveinvestingmastery.com. And I've written a bunch in Forbes. We have on that website, when you opt in, we have a wealth accelerator series that drips out an email every Saturday morning in perpetuity on different wealth building concepts that I learned, and I tell my whole story. I have 3 different best-selling books. We actually give away one for free on the website. And I'm happy to offer that to your listeners now, if you'd like me to, Kevin.
Yeah, that'd be great. Please do.
So we have there's a couple of them up there. One of them is Persistence, Pivots, and Game Changers, Turning Challenges into Opportunities. And I'm here, and there's Phil Collins, lead guitarist of Def Leppard. There's NBA, NFL players. It's a really fun book. Amazon #1 bestseller. We also have thought leadership. But if you go to passiveinvestingmastery.com/book, passiveinvestingmastery.com/book, that's the secret link. Make sure you put either Kevin Bupp or Sunrise Capital in the promo code or something, because we get a lot of randoms filling it out. I don't do anything with those. But if you indicate how you heard about us, I sign it and we ship it to you. We also let you read the ebook right there, so you don't have to get the physical copy if you don't want. But I see Kevin's got a bunch there in the background. I'm old school, it's my way of giving back. I tell my whole story, the fight, from high tech and then losing it all and then coming back and then single to larger multi and then other alts. And so I have a bunch of books. You'll see about 100 different, a bunch of kind of webinars and podcasts up there as well. So lots of cool stuff.
Awesome. Well, good deal. Well, Patrick, appreciate that. And guys, again, just be sure to drop my name there. You'll sign a copy. I love physical books. I mean, it's funny. I'm one of those guys. I've got basically the audio version of every physical book I have. I got like 3 different bookshelves, but I like both. But I love having the physical copy. So I'm still a dork in that way. I like to look at it
Kevin.
and feel it. Yeah, no, I will. But
Mm-hmm.
no, Patrick, always good catch up with my friend. You're a wealth of knowledge. Appreciate you coming on the show here. And again, guys, we'll put all those details in the show notes. And with that, bud, yeah, no, I appreciate it. That was a fun conversation. I love talking about things I know nothing about. I was very curious when I kind of just kind of dove back into a little bit of what you guys are doing over there at Passive Investing Mastery. I saw that litigation financing, and again was really curious there, because I didn't Google, I didn't dive deep at all. I didn't try to learn as much as I could about it before I hopped on here. I wanted to get it directly from the source. So with that, I appreciate it. And again, for those that want to learn more, passiveinvestingmastery.com. Again, we'll put it in the show notes. They can you'll get you spend a lot of time on your website because you just have a ton of resources and information available there for free. So Patrick, my friend, wishing you all the best here in 2025. Wishing you guys just great success with all you're doing, and we'll look forward again to catch up here in the future. Hopefully, we won't let
Same
another
to you,
year go
Kevin.
by before we reconnect.
Sounds good. Same to you. Appreciate you having me on.
Alrighty, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care now.